Last night, the U.S. Fed kept interest rates steady at 4.25% and 4.5%, taking a pause after recent cuts. In his speech, Fed Chair Jerome Powell signaled no rush to reduce rates further amid stable U.S. employment data and persistent inflation concerns. Locally, though, economists expect a 25% basis point cut in the repo rate, taking it to 7.5% today, but they differ on when the next cut is likely to occur. This is as the Reserve Bank takes center stage this afternoon. For more on this, we are joined by Koketso Mano, who is a senior economist at FNB. And then we have Frank Blackmore, who is a lead economist at KPMG, and Annabel Bishop, chief economist at Investec. Thank you so much for joining me, both Annabel, Koketso, and Frank. Annabel, let me start off with you here, because you read the statement, and then we have a market reaction having seen that statement, and then Fed Chair Jerome Powell has to feel all of those questions coming through from the journalists who were in the room. What were your takeaways from the Fed Chair?
So I suppose from a South Africa perspective, we saw a bit of rand strength. And really, if you look at where the rand was yesterday, I actually noted it down. At one point, it was 18.75, and today it's actually gone all the way to 18.45. There has been a bit of a market reaction. And I think certainly you could say that the expectation there has really been that the forecasts, the information portrayed, the statement is pretty much as expected. The decision is as expected. The interest rates were left unchanged. But what we do find is that maybe some of this fear has dampened down somewhat. We did have a lot of fear at the start of the year coming from what would the Trump administration mean? Would we actually see very substantial tariff increases? And obviously, would that be very inflationary? And in particular, then dim the outlook for interest rate cuts. And of course, last year there was an expectation of 3 U.S. interest rate cuts. That dropped down to only 1. In the last few weeks, it's crept up to about 2 again. I think maybe markets are starting to feel a little bit more comfortable. We do find in the U.S. that the tariff threats are being focused on factors which the U.S. administration would perhaps like to see change, whether it's illegal immigration, worries over drug imports, many other factors, and not necessarily protectionism aimed so much at trade and manufacturing. Apparently that is coming down the line, but the expectations are to be focused on certain goods such as semiconductors or, of course, as well, pharmaceutical, steel. So again, perhaps there's a little bit of market relief coming through. But overall, I think for South Africa, the expectation is very much, in line with the markets, no change in the US in January for the Fed funds rate. And of course, for South Africa, still hopes for an interest rate cut today.
Right. Frank, let's get your perspective in terms of what stood out for you from that press statement.
Component of it, based on the underlying policies. I think the intent has been communicated, but the extent and the implication and the timing, as you mentioned in your introduction, all will impact when and how far the Fed can change further lower those interest rates, hopefully for the remainder of this year. So for me, I think that was important. I think a lot of people in the market were trying to listen to any political messages that were coming through in the statement yesterday, because we've heard President Donald Trump obviously say interest rates must come down. And we wanted to, I guess a lot of the market wanted to know how Powell will react to that. And I think what he did was fairly sort of predictable in that he stuck to his lane. He didn't refer much to the politics at all, and said he's got to control inflation, his eyes on that inflation, and it'll be a wait-and-see approach to see what the outcomes may be. So I think that was my main message, just that wait-and-see approach.
Koketso, let's build on that wait-and-see approach. When do things become harder for the Fed?
Yeah, I mean, this wait-and-see approach is broadly as expected, given just how uncertain the global environment is. And in the US, we've seen relatively resilient growth in that area, and that has kept inflation relatively sticky. if you compare it to where the Fed would prefer for it to be. So I guess, that data dependency will remain in the system going into the latter part of the year. Current expectations are that maybe you start to see a bit more cuts coming through in the second half of this year, and that would obviously open up some policy space for SA as well. But as I said, I mean, the environment is quite challenging. We don't really know, the extent of the tariffs and how much that's going to affect either global trade growth or even inflation. It could create some supply chain disruptions. But there are also, counterbalances. If you think about what's happening on the oil front, for example, if Donald Trump or, policy in the US were to ramp up oil production, for example, at a time when, OPEC is also trying to bring more oil into the market, that could be something that dampens inflation. So there's still a bit of uncertainty to play out. So I think that's why markets are now expecting, further cuts to come through in the second half of this year.
Annabel, when you look at the role of the dot plots and, the confidence that one would gain out of forward guidance, are you still able to gain that confidence out of forward guidance with this Fed, given the fact that some would say the guidance has been dictated perhaps by policies that are coming from the Oval Office, and it's going to be quite difficult for the Fed to be able to tell us going forward what they're expecting themselves?
I think that's right in terms of trade policies, tariff increases, policies coming through in terms of, what changes is the US going to make in terms of protectionism, how's that going to affect inflation in the United States, and then, of course, as well, interest rates. We would not expect to see policy changes coming through from the White House, from the Oval Office, in terms of expectations around interest rates. In other words, the new president, or he's been president before, but our President Donald Trump now, is expected to make comments on many different areas, and he does. And of course, interest rates be one of them as well. But we don't expect him to be able to influence policy at the Federal Reserve Bank in the US. And I think that's really a key point. So I think, these are going to be the drivers. How does the economics change? In the US, of course, they're very happy with economic growth. They still feel inflation's a bit elevated, and that's why they've paused on interest rates. That's why we haven't had another interest rate cut. Similar for the housing market as well. It's cooled, but still robust. So overall, they're actually happy with the steady state of the US economy at the moment.
Frank, I want to come to you here because many would have interpreted that statement from the Federal Reserve as hawkish. If that statement is interpreted the way perhaps we should interpret it, as hawkish, does it then mean that there are no rate cuts perhaps for the rest of 2025? Does this statement set us up for that?
No, it doesn't. As I said in the previous comment, I think the sort of wait-and-see approach is exactly what it says it is. I don't even think this is a hawkish take, as Annabel sort of stressed in her point there. All that we're doing is a pause based on what we're seeing in the economy. And as far as the job of Powell and his committee would be looking at the state of that economy, whether there are risks to inflation, are those expected to come through, the timing of those risks, the severity of those risks, and base a decision around this. And what he has said is, with their larger upfront reductions that happened early on in the cycle, he's perhaps done enough at this point and has a wait-and-see approach on the future. So therefore, to answer your question, further interest rate cuts are certainly not out of the question. I think those would be coming in under the right economic conditions, and I think he's waiting to see those right economic conditions in order to pull that trigger.
When you look at rates in terms of where they are, I mean, some would say the Fed officials, face two broad questions in the weeks and months to come. Koketso, I'm going to come to you for this one. And the one question is price growth slowing in a way that will reach the Fed's goal of 2% in the next year or so? And the other being, to what degree are interest rates or broader financial conditions restraining economic activity? Which of those two is important for you right now if you had to get an answer for them over the next week or so?
I would say both, actually. Both are quite important. If you think about financial conditions, how they affect credit conditions, how the market behaves, could be seen as something if, for example, right now we consider financial conditions to be easier than, say, for example, at the early start of 2024, end of 2023. So if financial conditions have loosened, that is something that means that, you could see more credit activity, you could see financial markets becoming a little bit more vibrant, and that is something that can stimulate economic growth, right, and activity. So that would be something that adds to inflation and maybe reduces the impact of monetary policy. So monetary policy will have to consider, how financial conditions are and the restrictiveness of those financial conditions in helping them either get to their target of inflation, or in helping them decide whether policy from a policy rate perspective is restrictive enough. Now, when it comes to the inflation trajectory, right now it does not seem as though the Fed will easily be able to get inflation down, especially with the risks that are compounding when you think about trade policy, for example, as well as the decisions that have been made with regards to demographics, or deporting illegal immigrants, or even just tighter policy when it comes to immigration. Because that could mean, for a country which is similar to the EU, that has more gradually relied on external labor to feed into that market. If you take that labor out, or if you restrict the growth of that labor, that could be something that over time adds to your labor costs and creates more of an inflationary impact. So both are very important with how the Fed will consider how restrictive monetary policy has to be. Right now, you could argue that policy, obviously with the cuts that we've seen, has become less restrictive. And if inflation is more sticky, you might see policy actually becoming more, more accommodative or less restrictive than they would prefer for it to be in order to get to their target. So each are equally important.
Annabel, let's bring things locally and focus on the South African Reserve Bank. And, everyone's expecting a 25 basis point cut this afternoon. But in your note, you mention no cut at the March MPC meeting, and you're not expecting the SARB to ease interest rates again until July at least. What would change that picture for July where they don't cut at all? What dynamics would need to play out for this Reserve Bank to stay on hold from March going forward?
Yes, I think it's quite right to expect a 25 basis point cut in South Africa's interest rate today, the repo rate. And of course, we have inflation, CPI inflation at 3%. That's the bottom of the inflation target range, our 3 to 6%. As we know, it dropped actually below this 3% in the last few months. So we have a very low inflation environment. Unlike the US, we actually have a weak economic growth environment. Economic growth last year is going to battle to even make 0.7, 0.8%. There's great worries about the economy. We know there's structural issues, but also there's been weak demand. Consumers will benefit considerably from interest rate cuts this year. We expect 0.75%, 75 basis points this year. While we think that the next interest rate cut may only come in the at the July meeting, possibly May, much is going to depend on what happens in the United States, with the US not moving last night as they feel that their monetary policy is sufficient for where their economy is and where the economy is expected to go. If, of course, we move into an environment where we do significant changes from a protectionism perspective in the United States, higher inflation could obviously have a negative impact on the expectations of the Federal Reserve Bank in the US. That could change their interest rate trajectory. And of course, an interest rate cut expected in the US only in June. So that's the first time it's expected to be an interest rate cut this year. That could provoke that July cut. You see, what happens in South Africa is if we cut our interest rates too much, and the United States, of course, doesn't cut, we could be in line for very substantial rand weakness, a narrowing of the interest rate differential between the US and South Africa. And of course, there needs to be a margin there. There needs to be some width because of the fact that South Africa is a risky investment in terms of our financial markets. These portfolio flows do require some significant return. So that's why we're looking at the moment for July after a June rate cut in the United States. But of course, we will see as we move through the year how things change.
Frank, let me come to you here, because one of the other things that we might need to consider, even though it may not necessarily be the base case for 2025, is the possibility that if we look back at how the US economy started 2025, we started off with an economy that had some really strong tailwinds. We still have a lot of uncertainty that we have to anticipate coming out of the Oval Office. For the Fed to have to hike at the later part of the year, what would need to happen? Would these strong underlying indicators that we see in the economy have to persist? Would inflation have to still be one of the things that we're fighting, and because it can't get down to 2%? What would need to happen for you to believe that the Fed might have to consider a hike?
A lot of the wave that you're referring to was sentiment-based. So what that means is, although the sentiment of the economy was more positive at that point, that still has to translate into the real economy, and that takes a period of time for it to happen. So obviously, industries would have seen Trump come in. They would have anticipated tax cuts, perhaps. They would have anticipated fiscal spending in the right areas of the economy. All those things would promote buying power of individuals and businesses in the US, right? Now, the missing part of the picture is you don't want to get in front of that curve and make your decisions now, and then what was expected to happen doesn't turn out to happen, and that's the uncertainty you were speaking about too. But if we see what the governor is probably expecting, the Fed chair is probably a scenario where the sentiment fades and the economy, we still see good growth signs in the economy without those overheating signs. So inflation is key and at front of his decision-making process. And as long as we see growth with inflation staying in check, there might be scope again for further further cuts, as you said, later in the year. But one has to see what the outcomes are. You can only make this type of policy on the outcomes in the economy, not the expectation. The expectation is good. What are the outcomes going to be?
All right, Frank, let's leave it there. Thank you so much for joining me. And I do hope that we'll catch up in the next month or so as, events develop around the central bank policy for 2025. However, the voice that you heard there was Frank Blackmore, who is the lead economist at KPMG. And of course, he was joined by Koketso Mano, who is a senior economist at FNB. And we had Annabel Bishop, who you can see there on your screen, chief economist at Investec.